Thank you for joining us. This is Legacy Private Trust, first of two videos. Today we're going to focus purely on 2024, a year in review, the economic and market overview. Our next video is going to come out at the end of next week, where we're going to focus solely on our 2025 outlook. I am Peter Schaefer, and I'm joined by Connor O'Brien, one of the portfolio managers here at Legacy Private Trust. He's going to walk us through 2024, and he's going to talk to us about a bull market rages on. He's going to talk to us about rates and their reaction to the economy and policy change. Also, we had an election. We're going to talk a little bit about winners and losers post-election. Again, not focusing on 2025 just yet. That's going to be our next video. This is purely what happened in 2024. So Connor, let's just dive right in. What happened with the markets in 2024?
Well, you'll notice there's not a lot of red on this screen here. And to say it's been a good year in the markets is a pretty huge understatement. The S&P and the NASDAQ were up over 26% through yesterday. The Dow and the Russell were up north of 20% on the year. And as you can see, all four major U.S. indices are essentially back to all-time highs. Foreign has been marginally positive, just north of 10%, while fixed income, it's still lagged and it's still trying to crawl its way back from the highs back in the summer of 2020, but still an incrementally positive year for bonds. So no beating around the bush. It was just a great year for investors all around. All 11 sectors of the S&P were positive. It was the second best election year ever. The S&P has closed at a new all-time high 57 times this year. It's the fifth best year ever in that regard. And we've had back-to-back years of essentially 25% returns for the S&P 500. So there's very little to complain about if you've been invested in these markets.
So Connor, you got to tell me a little bit about why the markets did so well this year.
Yeah, so this is from our 2024 outlook that we recorded last December. And this chart answers the question of why have markets done so well? As you can see, there are a lot more circles on the middle and right-hand side of this chart than the left. And it really was the year of the soft landing. When all is said and done, we're probably looking at right around 3% real GDP growth in 2024. And that was led by the resilient consumer. We've also had a deceleration in inflation this year, not quite down to the Fed's 2% target, but within spitting distance. We'll also likely have between 9 and 10% earnings growth on the S&P. And on top of EPS growth, you saw multiple expansion from 21 to around 25 times 2024 earnings. So really, there's not much else you could have asked for from an economic perspective here in 2024. Now, despite the economy holding firm, it wasn't necessarily this smooth, steady upward climb in economic data. Looking at the light blue line here, that's your Citi Economic Surprise Index. It tells us how economic data is coming in relative to expectations. The first third of the year, kind of through March, you saw this data coming in really firm. Strong payrolls, firm inflation data, solid retail sales, and bonds took a hit as rates increased. You see the dark blue line is the price of a 10-year Treasury bond, obviously fading as economic data outperformed expectations. Things came back down to earth kind of at the beginning of April and May. You had a flat CPI print in May. You had a negative inflation print in June. We had weak payrolls in April. The unemployment rate started looping up to, I think it hit 4.3% in July, which is the highest unemployment rate since 2021. You had ISM services data fall down below 50. And all of a sudden, everyone that's been so worried about this recession that economists have been calling for over the last several years said, it might be time. This might be here. And we just sort of slogged through the summer. Rates fell and bonds caught a bid as that growth scare kind of set in. And then just like that, beginning in the fall, things just sort of picked back up. The unemployment rate topped out and started reversing. Inflation data firmed back up. We had a really strong quarter in Q3 for GDP, right around 3%. And we've ended the year essentially on a high note for economic data. We're probably looking at north of 3% GDP here in Q4. And this has just sort of been this dance all year long between economic data and rates. Econ data up, rates down, bonds down. Or sorry, rates up, bonds down. So all in all, a bit of a roller coaster ride, but a solid year of economic growth in aggregate. And on the back of that solid year of economic growth, we've seen rate cut expectations pushed up and pushed out. We came into the year with the market expecting right around 150 basis points in cuts. We'll likely get probably 100 basis point in cuts, which includes a 25 basis point cut next week at the December 18th meeting for the FOMC. At the same time, futures have really kind of bumped up their expectations of the Fed's terminal rate. So the terminal rate is where the market expects the Fed to hold rates steady after this rate cutting cycle ends. Ideally, this is the Fed funds rate that is neither restrictive or accommodative to the economy. It's also called R star, the neutral rate of interest. At the beginning of the year, expectations were for a neutral rate of under 3%. And a year later, markets have come to the conclusion that the environment we're in right now, that of higher deficits, that of more spending, more or less globalization, is a more inflationary environment and one that demands a higher neutral rate of interest rate, somewhere around 3.5 to 3.75%.
Perfect. Thanks, Connor. So obviously, as we've seen the economic data quite a bit stronger, the year of the soft landing, as you put it, we saw markets really respond favorably. Now, it wasn't just about economic data this year, right? I think there was an election. So I have to know, as we look back at sort of what the markets have done since the election, there have been winners, there have been losers. I'd love it if you could share some insight on that.
Yeah, we'll talk more about sort of specific policy implications in our 2025 outlook, but it's been pretty fascinating to watch the Trump trade, as we've heard it called, play out in real time. So first and foremost, Trump is vocally pro crypto. You've heard him talk about it. You heard his SEC chair. The SEC chair he's replacing Gary Gensler with is pro crypto, and you've seen essentially the whole crypto sphere rip higher. And Bitcoin is there in light orange. Tesla has also exploded as Elon has become essentially a pseudo cabinet member of Trump's. Banks have also caught a bed here, as they will likely be some of the biggest beneficiaries of the new, less strict, less stringent regulatory environment. And on the other end, we all know Trump's history with China. Right, he's obviously a hardliner when it comes to trade, and we're already getting a taste of potential policy changes there. So you've seen China struggle here through the last month or so. Trump's policies are also expected to be a bit more inflationary at this point. So you've seen fixed incomes sell off a bit in the last month. So it's still very early. We'll talk more about policy later on, but it's been fun to watch certain market segments react to what was a roller coaster of a political season that I think we're all very happy is in the rearview mirror.
Exactly. Well, thanks, Connor, for just really, really great insights into, frankly, what was a tremendous year for just about every asset class. Hopefully, our recap video at the end of next year is going to be equally as upbeat. Unfortunately, we have to wait a year till we get there. But good news is you can join us again at the end of next week when we have our Outlook video where we can spend a little bit more time on policy. We can spend a little bit more time on asset classes that we think are going to be good opportunities for next year. And frankly, there will be some asset classes we're going to want to shade away from. So we'll touch on all of that at the end of next week. But in the time being, if you have any questions and you are a legacy client, please do not hesitate to reach out to your legacy advisor. If you are not a legacy client and interested more in just how we manage money or just some more information on what we do on a day-to-day basis, please feel free to reach out. You can reach us at info@lptrust.com. Thanks for joining us.